In November 1923, during the period of the Weimar Republic, Berlin had awakened to a grey morning. The fog that had fallen over the city like a shadow seemed to describe not only the air, but, as if, the economy itself as hazy. People had lined up in front of bakeries. They were waiting in line, not with bread baskets in their hands, but with bundles of banknotes. Prices expressed in billions were being spoken of for a single loaf of bread. The figure set in the morning was being erased by noon and updated with a higher price in its place. So to speak, before the ink on the money had even dried, its value had already fallen. While mothers held their children's hands, fathers were carrying their money in sacks because it would not fit into their jacket pockets. In those days in Germany, money had ceased to be a medium of exchange and had almost turned into a wreck racing against time. What had been experienced in Weimar Germany was more than an economic crisis. It was a social tragedy. People were thinking that if they did not spend the money in their pockets by noon, they would not be able to buy anything with it by evening. In restaurants, prices were being calculated according to the order and were constantly changing. Children were making paper airplanes out of banknotes because the price of the paper had almost become equal to the price of a toy. Those referred to as the middle class had lost all their savings, and fixed income workers had become impoverished within a very short time. Distrust had increased, and this feeling had begun to erode faster than inflation. The most painful part of those days was that people had lost not only their money, but also all their beautiful dreams about the future. Years had passed, and the world had changed. But fate's game had not changed again. In 2008, a similar incident had been experienced in Zimbabwe. The central bank had printed trillion-dollar banknotes. And as the numbers grew, the economy had shrunk. People were trying to buy bus tickets with 100 trillion banknotes, and money that had value the day before carried no meaning the next day. Market shelves were emptying one by one, and price tags were constantly rising. As the zeros written on the money increased, people were losing hope, and those zeros almost symbolized people's dreams. As they say, history repeats itself. In 2018, the same drama had been experienced again on the streets of Venezuela. The bolivar had rapidly lost its value, and salaries had disappeared before they were even withdrawn from the bank. People were struggling not to fill their shopping carts, but to carry the cash in their hands. The public was striving to convert their savings into foreign currencies or gold, searching for a safe haven. After 2019, the lines formed in front of banks in Lebanon had turned into one of the most dramatic scenes of the modern era. People had not been able to access the money they had saved for years, and had seen that the figures written in their accounts carried no value. The gap between the central bank's official rate and the street rate had struck their faces like the ruthless slap of reality. Money that once had a certain value had almost completely melted within a few years. This was not only a monetary collapse, it was a deep wound embedded in a society's memory. Although these examples seem independent from one another, they all tell the same tragic story. The collapse had begun to show its face slowly, was then met with denial, and afterward had gained speed. According to the possible causes of this collapse, states had spent more than their revenues. Budget deficits had risen, and the debt burden had increased. As a solution, printing presses had been operated, more banknotes had been printed, and the money supply had been expanded. At first, this expansion had seemed relieving, and stability had been targeted by providing liquidity to the market. However, since the production of goods and services had not increased at a parallel rate, the amount of money in the market had not corresponded with real value, and each newly printed banknote had slightly reduced the purchasing power of the existing banknotes. Then prices had started to rise, first gradually, then visibly, and finally reaching an uncontrollable speed. People had turned to spending in order to protect their savings, because the longer money was held, the more it lost value. This behavior had led to an explosion in demand and had pushed prices even higher. Trust in banks had decreased, deposits had been withdrawn, lines had formed at exchange offices, and the process had become irreversible. As a measure, states had implemented various controls and introduced withdrawal limits. As the gap between the official rate and the free market rate widened, a black market had emerged. The economy had split in two, and the distance between the officially announced figures and real life had increased considerably. Eventually, local currencies had become symbolic. Salaries were increasing in numbers, but shrinking in real terms. Distrust had reached its highest level, and societies had turned toward alternative stores of value. This scene, repeated throughout history, had been based more on human psychology than on an economic model, and it had been an unchanging behavior. In the past, every collapse had directed people to the same question. If money dies, what remains valuable? From Weimar to Zimbabwe, from Venezuela to Lebanon, the answers had always been similar. People first remember precious metals, namely gold and silver. Precious metals that states cannot create supply of and that are accepted beyond borders regain value. Gold, like a silent, patient, and helpful friend, takes its place again in every crisis. From past to present, currencies have changed, regimes have fallen, but gold has continued to carry the same fundamental strength. Then a shift toward foreign currencies with strong economies begins. Every value outside the melting currency of that society becomes an escape plan for people. Instead of local money, the dollar, euro, or other stable currencies are preferred. This is not an ideology, but a survival reflex. Another direction is toward productive assets, especially the shares of companies that can generate income on a global scale. These shares may rise rapidly in nominal terms because the factories, machines, and lands they represent are real. Companies that earn part of their revenues in stable currencies gain a competitive advantage as the local currency weakens. In such periods, a stock is not merely a piece of paper, but a representation of tangible production and real value. In times of crisis, essential goods that can be bartered in daily life also become temporary instruments of value. basic necessities such as food, fuel, and medicine function as money. However, these do not provide long-term gains, but only a temporary breathing space. And ultimately, land, especially agricultural land that produces food, clearly shows that production, not money, is the real power. From the Great Depression to modern crises, people who owned land were able to meet their own needs. And while money melted away, their land preserved its value. History tells us this: currencies are temporary, value is permanent. When the economy collapsed, trust disappeared, the paper burned, but production, labor, and tangible assets continued to live on. Collapses are always dramatic, yet they always deliver the same lesson. Savings are fragile and insecure when tied to a single currency. A structure that is diversified, crosses borders, and is based on tangible values is more resilient and secure against storms. In the dusty pages of the past, we can find many more lesson-filled stories. People waiting in bakery lines, families standing hopefully in front of banks, workers holding trillion banknotes in their hands. They had all asked the same question: when money loses its value, what remains? The answer has not changed for centuries. Precious metals such as gold and silver, stable foreign currencies, productive company shares with international income, essential consumer goods that gain value during crises, and agricultural lands that produce food. History left us the same silent warning every time. Where there is no trust, money could not survive.